In today's video, we're going to talk about the importance of investing over the long term, but why it may not make sense to invest in the stock market in the short term. And we're going to talk about how to build a retirement income plan so you can get the best of both worlds so you can live that retirement that you dream of. So here's the one chart that we need to look at to understand the importance of investing in the stock market in the long term and why why you're able to do that. And so if we look at this chart, what this chart is showing us is that over let's say for a 15-year, start at the far right, over a 15-year period, the market has never been down over a 15-year period if we look back over the last 50 years, okay? And so also the market has never been down over a 15-year or over a 10-year period over the last 50 years. So from 1973 to 2023, we have never seen the market down over a 10-year period. And then if you look at, and by the way, the market, what I'm referring to is an efficient portfolio. This is from IFA.com. And so IFA is all about an efficient, diversified, well-diversified equity portfolio is what we're looking at. So we're looking at basically investing in stocks, in a variety of different stocks across all different types of sectors and industries is what we're looking at here. And if you have that type of portfolio, which is what we typically recommend for most retirees, is not 100, and by the way, I want to be clear, not 100% in this type of investment, which is why we're going to talk about maybe you shouldn't put everything here, but understand that, hey, if we are going to invest in equities, you want to make sure it's diversified. We probably don't want to just go buy Amazon and Apple and Microsoft, because although they're the big companies now, we don't know if that's always going to be the case. If you look back 40 years and look at the best companies there, not all of them are still the best companies today. So what is going to happen in 10, 20, 30 years from now with those types of companies? I still feel pretty optimistic about them, don't get me wrong, but you've got to understand that it may not always be the case. We don't want to risk just investing in a few companies. We'd rather have hundreds and thousands of companies that we're invested in. So back to my chart here. Now if you start getting closer to that zero, from 15 years to zero, over a 5-year period, then you're going to look at seeing the market's only up or it's only down 4% of the time. So you could go a 5-year period, 5% of the time about, and not see any positive return, which meant your investment was down over a 5-year period. And then over a 1-year period, it just says that 76.6% of the time the market was up just over a 1-year period. So if you just went from today, 1 year from today, it's a 76% chance it's going to be positive over the last 50 years. So pretty neat to know. Now, if you look at just a quarter, so that means every 3 months, then it's not going to be, it's not going to be as high because there's more volatility that can happen in a short amount of time. And so in that case, over a 3-month period, it's still a 68% chance the market's going to be up. So you've probably heard the term that, hey, over time, the market's going to be up about 2/3 of the time. It's going to be down 1/3 of the time. That's what they're talking about is really a 3-month period is kind of the idea there. Or close to a 1-year term if you get the point there. Now, if you just look at over a 1-month period, then over a 1-month period, 64% chance going to be up, 35% it's going to be down. So as you can see here, we're starting now to almost flip the coin to see is it going to be positive or negative over a 1-month period. So if you look at the days basically means that, hey, you're flipping a coin if the market's going to be up or down tomorrow. We just don't know, right? And so I'm making this point to you because if we are doing long-term investing, how I started out the video, then it starts to make more sense for us to invest in equities. So how we position our portfolios for our clients is what I'm going to tell you here. In all the decisions that we make in financial planning for our firm, for our clients, it's all research-based, and it's all based on analytics and what do we expect it to be the best. Okay, so we're not just throwing darts to make decisions. We're seeing what research can we have, and we're seeing what makes the most sense. And so in this instance, we tell our clients that if you need your money within 5 to 10 years, we're not going to invest in the market. And then depending on our client's risk tolerance, tells us that they should have 5 years or 10 years as that number. And why do you think we use the 5 to 10 years? Well, you're looking at it right here. Because if we can wait 5 years, if the market goes down, history tells us that if we just wait 5 years, most of the time it's going to be positive. So if we just have enough time, if we just buy time, then we're going to be able to have a better chance of not losing any value if we're investing for the long term. So, we see people at, some of the workshops we do, and they go, oh man, the market's down today. And we basically tell them, well, stop looking at it. I mean, yeah, we never want to see the market be down, but if you've got a plan, you shouldn't have to worry about it. And so if you just look at it every day, you're going to drive yourself crazy. But you've got to think long term, right? If you look at it every day, you only got a 50% chance it's going to be in the green or 50% chance it's going to be in the red. If you look at it over a 5-year period, now, it's going to be heads 96% of the time. It's only going to be tails 3.3% of the time, right? So just understand, if we're long term, that's when this can start making sense. And so for our clients who are really conservative, we typically go 10 years of making sure that they've got enough protected income that's not impacted by the market, so that they don't have to worry about the ups and downs over time. Because over a 50-year period, the market's never down over a 10-year period. Now, don't get me wrong, the market could go down over a 10-year period. It can happen at any time, but it's just not what we've seen. So that's what we want to look at. Now, like I said, anything in 5 to 10 years before that, I don't like us going to the market to get the money. I'd rather look at more protected vehicles where we're not going to have to worry about market downturns. And so you've got to be aware that stocks or bonds are still going to see market downturns over the short term. So if we go to, an IFA 0 portfolio, this is going to be more of your fixed income type assets, which people tell you, hey, fixed income, that's protected. Well, how protected is it really is my question. And so if we look at the chart, fixed income, it could be up or down. Flip a coin if it's going to be up or down. And you probably saw that in 2022, for example. The bond market was down about 15%. Fixed income was down about 15% for most people that we saw who own that type of asset. And so what we're saying for this 5 to 10 year period, that 60-40 portfolio you hear about, 60% stocks, 40% bonds, it may not be the best decision, because what's your bonds? It's a coin flip if you're going to need that money, if it's going to be up or down. And so that's why we probably want to look at even something more protected than stocks or bonds, because obviously they're not protected there. So that's the idea, because we want to limit these downturns. And so if we can just get through these downturns without having to worry about it, then we're never facing what we call sequence of returns risk, which is retiring at the wrong time, when you have to force what we call a double loss. So if the market goes down, as we're saying, and you have to take out money, then it's a double loss. And our question is, do we have enough time to make it up? And that's why positioning your assets to have this retirement income plan is so important. So I love this chart. I think it really puts it in perspective for us, especially when we see market volatility like we've seen over the last few years. It goes up and down and up and down, but you've got to think big picture, okay? Understand historical evidence is no indication of the future. So we've got to keep that in our mind, but we also got to be smart enough to understand that, hey, we've got a long-term plan, we've got a long retirement here, and inflation is going to be pretty serious, and so we've got to make sure we keep up with that. And over time, equities is the best way to outpace inflation, is what we've seen. So fun video today. If you're an analytical person, go ahead and reach out to the comments there and give us some feedback and what you think here and what you want to hear more about. And go ahead and hit subscribe, and we'll keep the videos coming. Thanks now, and have a great day.